Welcome and thank you for joining me for today's presentation on the US exit tax and planning around this very challenging change to the law that was brought about in 2008. We've got clients, prospective clients, and simply interested members of the public joining us here from all over the United States and Australia. So welcome to everyone. A few disclosures here. This does not constitute personal financial tax or investment advice. You are advised to seek personal counsel. This is an extremely complicated area of law. All information obtained here, we believe, has been obtained from reliable sources. And you might note that style note down the bottom there. It is important to note, as I do every time I do a webinar, we always record the webinars. If you register for the webinar, you'll be notified of the recording. If you don't register, you won't be notified. They're always recorded, and you'll always find them on our YouTube channel. And I'd encourage you to subscribe to the YouTube channel if this is a topic, if these general US-Australia cross-border wealth management topics are of interest to you. A little bit about me. So I'm a tri-citizen, born in the UK, raised in Australia, lived in the US for 16 years and shall be returning to the US in August of next year. Went to the University of Queensland, just down the road here, about a mile from where I am currently. Moved to the US in 2005. I had a career in corporate finance before seeing the light, the angels sang, and I saw my calling as a registered investment advisor, a fiduciary who has the highest legal standard in representing their clients, and that's what I was drawn to do. Founded Arete Wealth Strategists in 2013, and really spent the past decade building this particular knowledge because I couldn't find it anywhere. No one had looked at what the complex issues are that face cross-border individuals, and so that's what I dove into. And here's a quick example of the kinds of clients that we work with. Here's an example of an Australian business owner living in the US and the moves that we've taken to help her exit her business in the most tax efficient manner while reducing risk and getting the best price. Another example of a high net worth couple who relocated from the US to avoid, would you believe, the very exit tax we're here talking about today. And lastly, a long-term client of mine, an executive family that have permanently relocated to the US, had all manner of different things that tied them back to Australia: brokerage accounts, superannuation accounts, inheritances, investment property, and we've been able to help them make the right moves to simplify their global financial life. So that brings us here to today's presentation. I am extremely proud of the work that I've done, that my associate Kellen has done, that my estate and tax planning attorney partners have done. And also the PhD in tax and accounting, the work that he's done in putting this together. This is really extraordinary, and I haven't seen anyone anywhere put together such a condensed piece of knowledge on this particular topic. I will save questions to the end. I have one of those primitive male brains that struggles to talk, think, and respond to other things at the same time. But thank you, Melissa. I can see the well-wishing coming through there. So first, we're going to look at what is the Hart Act, who is affected by it, and what does it mean to be a covered expatriate? What is an act of expatriation? What are the different tax categories and how are they assessed? And lastly, planning strategies to avoid or minimize this tax. Now, I hope for those of you on the East Coast of the United States that you've had your coffee and not a beer or wine, because there's going to be a lot to go through and it is pretty dense. I'm going to do my best to liven it up and make it interesting, but let's just say you have been warned. So I'll do my best. I'll do my best. Okay. So let's get into it. The Heroes Earnings Assistance and Relief Tax Act was signed into law by President Bush in 2008. We could talk about all of the benefits that it provides returning veterans, but we're not here today to do that. Instead, we're talking about who's paying for it, and that would be expatriating individuals. In fact, that term expatriating is worthy of its own slide. What does it mean to expatriate? Well, we'll get to that. So it has significant consequences for US expatriates, meaning US citizens relinquishing their citizenship or long-term permanent residents who effectively surrender their green card and meet one of the tests that would deem them a covered expatriate. So we've got a chart coming up to illustrate all of this, because it's all of those words require definition. They're all very important. Effectively expatriating means not simply moving overseas. There's a whole rigmarole that goes with actually successfully surrendering your green card. Okay, if one is deemed a covered expatriate, of which there are 3 tests to meet, the Hart Act stipulates that the individual must pay an exit tax to the US government when they decide to relinquish their US citizenship or surrender their resident alien status, i.e. green card holder. Okay, so what are these 3 tests? We're getting there. But before that, what is this exit tax? People throw this around as if there's this one single nasty tax that you've got to avoid. In fact, it's not one single nasty tax. It's 5 nasty taxes that we need to be aware of. And we'll go through this in some detail as to their classification, what types of accounts. To the lay individual that looks at this, the classification doesn't necessarily make a whole lot of sense. This was written by tax attorneys. And so you do see some interesting combinations where, say, a specified tax deferred account would include an IRA, a retirement account, whereas an eligible deferred compensation account is a 401k. Why would you have accounts that are essentially for the same purpose being taxed differently? Well, it comes back to US trust law. But as I mentioned, we'll save that for a moment. Okay. So who is affected by it, and what does it mean to be a covered expatriate? So this is super important here, and I note that we have a tax attorney on our call here tonight. John Richardson is here, and he will know more about this, but this is a sleeper issue that very, very few tax practitioners or even tax attorneys even speak about, and I'm getting to that on the next slide. But the Hart Act really consists of 2 components. There's the income tax component to it, and that's really 99% of what tonight's presentation is about, is the income tax side that affects the covered expatriate. And then, interestingly, there's the estate and gift tax related element. This is the future impact. Now, very little has been written about it, largely because very little has been published about it from the IRS. But this is something that I have from good counsel that is a sleeper issue. It's something that will come back to haunt covered expatriates in the future, and it is nasty. So avoiding being a covered expatriate in the first place would certainly be a very important undertaking. Okay, so who is affected by it, and what does it mean to be a covered expatriate? Continued. I would love to read this slide really slowly. Okay, so the Hart Act affects those 2 individuals that I mentioned earlier, US citizens or long-term US permanent residents. So a long-term US permanent resident means something very specific. It means you've lived in the US for 8 of the past 15 years, and any part of a year, so much as a second into that calendar year, counts as a whole year. So therefore, if you exceed 7 years, that's 8 years and you're done. So we're on the lookout for the clock going beyond 7 years. A long-term permanent resident would then be counted as a permanent resident would then be counted as a long-term permanent resident, and therefore subject to the 3 tests that we're getting to in a moment. Let me see who expatriate from the US. Okay, another point to be made here is in possession of that green card. It doesn't necessarily have anything to do with your physical presence in the US. It's, did you have that green card for that 8-year period? So that's, or did you fail to effectively relinquish that green card and were in possession of it for that more than 8 of the past 15 years. and were deemed a covered expatriate. So we're getting to that in just a moment, what those 3 tests actually are. It is worth underlining at this moment who is not caught by this, therefore, and that would include visa holders. So if you are someone who's been in the US on an E3 or an L1 or something like that, then you would not have to worry about this because it simply wouldn't apply to you. That, of course, is a conversation all to itself because there's so much in determining whether someone wants to swap from a temporary resident status, namely a visa, to a permanent resident. There's all sorts of benefits, but there's also many drawbacks as well. Okay. What have we got here? We got the 3 tests. Let's look at these 3 tests. So first, there's the income test. This, I would say, is the least common way that folks fail this one, especially if they don't meet the next test. The lowest hanging branch would be the asset test. But let's just go back to that income test. So if you have an average annual net tax liability, federal tax liability, for the preceding 5 years of 171,000 in 2020, 172 in 2021, then you would be a covered expat. So you've got to be making real money to have that sort of a tax bill. And I just did some quick calculations and figured out it's about 570,000 if you're a single filer, or 650,000 married filing joint, to have and have been making that sort of money for that period length of time. Could there be remuneration events that skew your average? Absolutely. If there's some gigantic RSU vest or something like that, someone works for a tech company and they get some RSUs or options at vest that causes them to have millions of dollars in income, well, that's going to skew that 5-year average, as you would imagine. Anyhow, as I mentioned, the asset test is the one that much more commonly brings people into this covered expat status. Why? Because that's your global net worth. If you own a home in San Francisco, New York, or Boston, or any of the major US cities, and you've got some money in a retirement account, brokerage account, whatever, it's very easy to exceed that level. So 2 million global net worth. And they also want to know about the value in your superannuation account. I mean, that's why I've underlined global, is everywhere under every couch cushion if it exceeds 2 million. And then lastly, tax compliance. This is, really anyone on the up and up is going to be fine with that third one. So it's really that middle one that I think is going to catch out most people and where real planning needs to be done. Okay, so to help out with making sense of all of these complicated terms, we have created this diagram here for you. So what do we have? Let's follow the bouncing ball here. Is the individual a US citizen or long-term resident of the United States? Question, what is a long-term resident of the United States? Correct, that's right. They've been here for 8 of the past 15 years on a green card. Okay, next, did the US citizen relinquish their citizenship, or did that individual cease to be a long-term US resident, i.e. surrender their green card? Yes, they did. Okay, next, did they meet one of the 3 tests? Yes, they did. Bad news, you're a covered expat. If you didn't, if you did not have an average income of that, did not have a net worth of that, and you're good on your taxes, congratulations, the exit tax does not apply and you're not considered a covered expatriate. Let's pop the champagne. Okay, so what is an act of expatriation? I included this because you would think it's straightforward, but I discovered something in reading a Bloomberg tax article recently that made me sit up straight. And we'll get to that on the next slide, what that is. So expatriating, pretty straightforward for a US citizen. You surrender, you relinquish your citizenship. And that's a whole process unto itself to do that. Not simple at all. You cease to be a US lawful permanent resident. Again, you heard me at the outset. I think it was the second slide where I was introducing all this and I said, effectively surrendering it. Why? Because underlined down the bottom, merely giving up your green card or simply letting it expire does not count. The IRS doesn't say, oh, thank you, we're done with you. Wrong. You've got to submit your form I-407 with Citizenship and Immigration Services in quite a formal process. I don't get involved in that process. That's something you deal with an immigration attorney. But there is quite a formal process to undertake in order for that to be to take effect. Okay, well, here's the next thing that we came across, and that is to do with claiming residency of another country under the tiebreaker provisions of a treaty. If you do this, this represents an administrative surrendering of your green card. It means you're living overseas and claim to be a tax resident of that other country. That may also have the effect of effectively surrendering. So that is also very important to note. I haven't yet come across any client situations where that has been the concern, but that is something to watch out for. Typically, when someone has a green card, they're not going to be and has been a green card holder for 8 of the past 7 years. They're not then going to move typically overseas for 1 year or 2 years, claim tax residency of that foreign country, and then move back to the US. Just a rare tax pattern. You wouldn't, I mean, not to say it would never happen, but I just haven't seen that particular one. What are the different tax categories and how are they assessed? So specified tax deferred accounts. So what are they? Well, I've listed them out here. Traditional Roth IRAs, HSAs, covered Ls, very rarely see covered Ls, 529s, and medical savings accounts, very rarely see medical savings accounts. Okay, that's what they are. How are they treated? This is how they're treated. They're deemed as if they're fully distributed. What does that mean in English? That means the IRS comes along in them, looks at these accounts, says, oh, I see the value of that account was X the day before you expatriated. We're going to add that to your ordinary income, and you're going to pay tax on that just as if it was bonused out to you. So it could really skew the marginal tax rate that individual is subjected to in the year of expatriation. Do note there's no gain exclusion on these accounts because they're not deemed as gain assets. We'll get to that in a minute. I don't want to jump the gun and confuse anyone there, but there is a capital gain exemption, which does soften the blow for high gain assets. So let's just use an example here. Keep it super simple. Kelly here, a long-term permanent resident, has a global net worth in excess of $2 million. She submits her Form I-407 and commences the process to formally surrender her green card. She has an IRA worth $250,000. The IRA is deemed to be fully distributed. Does not mean it's actually distributed, so it still stays in its IRA. It doesn't actually move anywhere, but it is taxed at the prevailing marginal rate at that time, given her ordinary income. So she gets a step up in basis, which means when that is in actual fact distributed, she will only have to pay US tax on the amount above her new stepped up basis. But you're beginning to see this is how this exit tax works. This is the first of 5 categories. Next, eligible deferred compensation, to be distinguished between ineligible deferred compensation, and that's the 3rd category. But first, eligible deferred comp. What are we talking about? 401ks, SEP IRAs, and simple IRAs, employee pension plans. Let's say if you happened to work for the Mayo Clinic, for instance, and you got a pension plan, then that would be an example of an employee pension plan. Okay, eligible deferred comp, they're treated a bit better, in fact, quite a bit better in my opinion. To be considered an eligible deferred comp plan, they must meet 2 criteria. 1, the payer is a US person or legal entity. Remember, corporations are people, supposedly. And 2, the covered expat provides the payer with Form W8CE for covered expat within 30 days of the date of expatriation. It's an eligible deferred comp plan if that's the case. And here's how it's treated. Congratulations. It will be withheld at a 30% rate on all taxable payments. Super important. You can't then use tax treaty provisions to get a better outcome. For instance, and we've researched this point. This is maybe me being super finicky on this one, but You couldn't expatriate and then say, excuse me, IRS, the Australia-US tax treaty says that for residents of Australia, you have a 0% withholding. No, because the covered expatriate status would overrule that. So you're going to be withheld at 30%. However, the good news is you may still submit. I'm going to show you here my handy dandy never leave home without a key financial data sheet. You would see that 30%, you've got to have a pretty high AGI, i.e. Above 330,000 after your standard deduction or itemized deductions before you're in a greater than 30% bracket. So in other words, below about 330, you're in a lower bracket. So you'd be well advised to submit your Form 1040 NR for non-resident, and you'll probably get a refund back. So that's very good news. Okay, and you'll note down the bottom here is where I've highlighted this point on the W8C. It says very clearly that you're irrevocably waiving your rights to claim any reduction withholding at the treaty level. Okay, next, the third category, ineligible deferred compensation. This is where superannuation accounts in particular get caught, but also stock options, stock appreciation rights, RSUs that have vested but have not been settled, not been paid out yet. So typically, RSUs are pretty straightforward. Once they vest, people typically get the portion that is applicable. If there was a holdover for some reason and didn't settle until the end of the quarter, and you happen to expatriate before you had received them, then that would be considered part of this ineligible deferred comp. Problem with ineligible deferred comp is it creates a liquidity trap. You're getting taxed on something you don't necessarily have any access to, which is very bad news. So if neither of those two requirements we saw a minute ago, i.e. the payor is a US person, and you didn't submit this W8CE, then you've got yourself an ineligible deferred comp account, in which case you're going to get taxed. Again, it's at the same rates though, so it's not really any more punitive. The primary difference is that you can defer with the eligible deferred comp. So that's nice rather than simply withholding on the present value calculation. You can see here is the form. If you want some real good bedtime reading, you can look at that and see how they calculate those present value amounts. And that's what you're going to be taxed on presently. So that's the ineligible deferred comp account situation. And as an example to help illustrate this rather complicated point, James is an Australian American dual citizen. He's been making $800,000 on average over the past 5 years. He's planning to move back to Australia and relinquish his US citizenship. He has a superannuation account worth 400,000 Australian dollars or 300,000 US dollars that has been taxed as an employee benefit trust. That's important. Please go back and see my other video recently done on the taxation of superannuation, and you'll understand what the difference is there between an employee benefit trust versus a foreign grantor trust. But we're not going there right now. So no condition of release has been satisfied on that superannuation account, which would allow him to actually get the money out. Do you think the IRS cares? No, they don't. They say, you have that money, you owe us tax on it, and we're going to tax you on it right now. So that is not a very happy situation at all. Next, beneficial interest in non-grantor trust. This, I hope you're paying attention, because this actually forms one of the recommended strategies. It's just in the nuance of how the trusts are written that is the difference between being a beneficial, being a beneficiary essentially of a non-grantor trust versus being able to structure a trust in such a way that you may then become a beneficiary at some point in the future, but you're not at the time that you expatriate. So a non-grantor trust is any trust taxed as a separate entity from its beneficiaries. Many of us on the call here tonight may have revocable living trusts. They are not non-grantor trusts. They are very much grantor trusts. They are taxed, they are flow-through entities, they are taxed to you. So not complicated trusts at all. Non-grantor trusts have their own tax numbers. They're taxed at the trust level, and you've seen here I've included what the estate and trust tax levels actually are. So they ramp up far more quickly than what the individual numbers do. And under the Hart Act, special rules apply if an expatriate is a beneficiary of a trust treated as a non-grantor trust on the expatriation date. So what not to do? Have yourself listed as the beneficiary of a trust at the date of your expatriation. So if that is the case, then no gain is recognized on the expatriation date. But again, we've got 30% withholding. So we're seeing very similar withholding amounts of 30%. The point of this is that you want to have control over when that 30% hits, and ideally be doing good tax planning to make sure that you're well below that to minimize your US bracket as much as possible. Okay, some minutiae on how this is done. Okay, here's Ken, a covered expat. He's a 50% beneficiary of a non-grantor trust. Maybe his parents set that up, and it's great to be the beneficiary of it, but it's going to have complicated tax effects for Ken here, because every distribution is going to be hit with a 30% withholding, including his 2021 distribution, because that happened just before he expatriated, just before he received the trust distribution. So thank you very much. 30% is withheld. Again, may have to file an annual tax return as a non-resident and possibly get back what may be gotten back. And last and not least, in fact, probably the most interesting and relevant of all, is the mark-to-market asset treatment, which is essentially what applies for everything else. This is the one category where there is some good news. You'll see here in the first bullet point that there is a $767,000 gain exemption for capital gains assets. So that's nice. We'll get to strategies in a moment, but obviously making use of that is going to be high on the priority list. Any gains or losses from deemed asset sales are taken into account. So this is basically how everything else is treated. Is it all treated as capital gains? No, because right here it says the character and holding period. So if you've got short-term capital gains, if you've got investment property subject to depreciation recapture, if you've got artwork or collectibles that are going to be taxed at a different rate, then you would be taxed at that appropriate rate. And I don't believe that that exemption would necessarily apply to those other assets. Okay. Example, Jane is a US green card holder and an Australian resident. She's been resident in Australia for the past 5 years. She has a global net worth in excess of 2 million, which makes her, yes, a covered expat. She's a citizen and she has more than a $2 million net worth. Okay, therefore she is, oh, I said citizen, excuse me, green card holder is right there. Long-term resident, but it doesn't matter, it's the same outcome. She's a covered expat. She submits her tax return claiming she is an Australian tax resident and thereby administratively expatriates from the US. That's a big no-no. If she wasn't planning on doing that, at least it's a big no-no. Included in her global balance sheet is an investment property of hers, in San Francisco that she bought way back in 2005 for the paltry sum of $800,000. It's now worth $3 million. As this was not her primary residence for 2 of the past 5 years and the gain exceeds the exemption amount, she's on the hook for $1.433 million taxed at the prevailing capital gains tax rate, which is not going to be pretty. So the other thing that's not pretty here is because it's real estate. What do we know about real estate and source of income? Well, Governor Newsom is going to be there with his hand out asking for his 9.3% as well, because it's California sourced gain. So you're getting hit with the federal, you're getting hit with the state. It's not going to be pretty. A lot of tax to pay once that property is actually sold. This is an important concept here. Remember, when you expatriate, you don't necessarily have to sell everything and be done with it. That's not what's happening. It's merely as if you're assessed as if you'd sold it. So she may continue to own it. It's just she's going to get hit with a big whopping capital gains tax bill. And then, just to finish my thought, the day that she actually does sell it, that's when It may not be Newsom by that point, it'll be someone else. They'll have their hand out for the 9.3% remaining. Okay, additionally, a special transfer tax is applied to any US recipients of a gift or bequest received from a covered expat during the covered expatriate's lifetime prior to expatriation, although there is a 3-year limit there and then another 5-year limit, which we'll get to in a moment. Expatriates may elect to defer the tax until the due date of their US tax return for such deemed dispositions, but only if adequate security is provided to the IRS. All right, so let's get into strategies. How are we doing for time? We're about halfway through, which is about perfect. Okay, so planning strategies. I've got 4 strategies here for you. I think this particular area of tax law is not a do-it-yourself area. I've recently made a fine distinction between there are do-it-yourselfers and there are learn-it-yourselfers, and then there are do-it-yourselfers and learn with professional instruction. This is neither of those things. This is neither learn it yourself and do it yourself. It's learn with a professional and do with a professional, because the mistakes can be hideous and impact the next generation as well with inheritance taxes. Okay, so first strategy here is take your capital gains exemptions and step up your basis progressively. So first point, as you heard me say a moment ago, there is a $760,000 capital gain exemption. So make use of that. There's no point stepping up the basis on all of your assets, converting everything into cash, paying a whole bunch of capital gains tax, possibly at higher rates, because you've got this fear of paying an exit tax. No, there's a $750,000 exemption. So let's make use of that. Next, let's look at your global balance sheet and see what the composition of assets are. Most people will have a primary residence, possibly own their own home. Remember, you've got a $250,000 exemption for single filers, $500,000 for married filing joint. So wouldn't it be smart to sell that property, make use of that additional up to $500,000 exemption, and not have that come out of your $767,000 HART exemption? You may also undertake tax loss harvesting, that is offsetting winners with losers, and you can take up to $3,000 of losses as against your ordinary income. That's quite a bit different from in Australia, where we still have the negative gearing rules. So any losses from, they don't call it passive activities, but passive activities from investment real estate, for instance, you can use to offset your ordinary income. The US did away with that back in 1986. Okay, so the basis reset strategy here, this is the most boring of all. And you thought you'd heard the most boring, but wait for it. This is the least sexy, the least sizzle, I should say, in this particular one. The basis reset. This is where you'd better be wedded to your tax planning software or your financial advisor and having these conversations frequently. Why? Because if you have a massive income spike in 1 year, it could push you up from a 0% rate to a 15% rate, or from a 15% rate to a 20% rate. That could be really nasty. And remember, in the actual year of disposition, not the year of expatriation. I mean, when you actually sell an asset, as we're talking about before, remember that states like New York and California have also got their own progressive income scales. So you could get double whacked in those years if you don't do adequate planning and you have massive spikes in your income in those years. So what I'm saying here, to put it all very succinctly, I would say progressively step up your assets over time, so that you don't have gigantic gains just lingering around in some particular asset of yours. Next, progressive gifting to a non-expatriating spouse. I would encourage you to go back and look at the webinar series that I did mid-year to do with planning for non-citizen, or I call them mixed nationality spouses. That's a whole nother topic unto itself. And that's where this comes in. So the thing with having a non-citizen spouse, and I mean green card holder or even a non-resident alien, that's the charming term that the US uses for a spouse that is not even a temporary resident, they're not a legal permanent resident, they're just a nothing, that would typically be the case. Someone living in Australia, an American citizen married to an Australian citizen, that Australian citizen is called a non-resident alien. Well, the gift limit, the annual gift limit that applies between US citizen spouses does not apply in that situation. That US citizen spouse can only gift up to $159,000 in a given year before their lifetime exemption is tapped. Now, that's not the end of the world because it's a pretty high amount. It's 11.7 million currently. But it is important to be aware of that you're going to be dipping in very, very soon. So what can we do to be smart about our gifting strategies? We could progressively gift and equalize before that expatriating event takes place, and therefore bring that expatriating spouse's assets down below the $2 million level, and voila, we've just avoided covered expat status. Or do the next strategy that I'm going to mention in just a moment. The fourth bullet point here does allude to that, the two webinars I did on planning for mixed nationality spouses, where you might elect the spouse to be a resident for US income tax purposes, may improve the gifting strategy a little bit, but it does entail all sorts of other heartache. And so that's not a decision to be taken lightly, because then the non-US citizen spouse would therefore be considered a US tax resident going forth, and that would negate the whole purpose of the expatriating spouse. So lots of thinking to be done before considering that. Bob, a US citizen, is married to Linda, an Australian citizen. Okay, so we have an NRA married to a US citizen. Bob is planning to expatriate from the US to Australia in about 10 years' time. He's got a net worth of about 2.75 million, while Linda's is $300,000. Fantastic. Okay, so what's Bob to do? He might gift progressively over that time to Linda, bring his estate down significantly, and not be a covered expat at all. That would work out well, and would be happy with that outcome. That would be very simple. Alternatively, he might look at strategy number 3, which is pretty sophisticated. I won't lie. This is one where you will get into working with an estate and tax attorney to implement this, and there's annual ongoing costs for it. But considering that you may be staring down the barrel of a 40% tax to the next generation on the gifts or inheritances to a covered expat's kids, this could really make a lot of sense. So gifting to an irrevocable trust. How, I just want to be clear and get in front of this one before someone writes in with a question. How does this make any sense, strategy number 3, when, if we go back to looking at the different tax asset classes for the exit tax, if one of the tax asset classes is beneficial interest in a non-grantor trust? How does that make any sense if I'm simultaneously saying that, why don't you set up a non-grantor trust? Well, this is how, because there are ways that such a trust could be structured as to make it so that the grantor to the trust is not a present beneficiary of the trust. This is a pre-expatriation trust, ideally set up 6 years before expatriating. And then upon expatriation, they're able to then redraft that trust and become a beneficiary once again. So that gets around that particular issue with the irrevocable trust. Like I said, pretty complicated, pretty involved planning right there. I'm just going to skip through that particular one and move on to strategy number 4. This is a pretty easy one. I like this one a lot. So rolling ineligible deferred compensation items into specified tax deferred accounts. So this would be the case of rolling your IRA balance into your 401k. Perfect. Why? Because in the year of expatriation, let's say you've got hundreds of thousands of dollars of other items that are going to be taxed. That's going to spike your marginal tax rate. We don't like that. Why not roll that IRA into a 401k if that is allowed by the plan documents. And then we can take that distribution. Now, granted, the IRS is going to withhold 30% on us anyway. That's fine. But maybe we're in a lower tax bracket at that point, and we could submit a tax return and get that money back. That would be that could have significant tax alpha, that particular strategy. And here we see an example with Jennifer, a covered expat. She's planning to retire and answer U.S. citizenship and move to Italy next year. She's going to be a busy lady. She's got a current IRA balance of $500,000 as well as $300,000 in her current employer's 401k plan, which does accept rollovers. Due to being a resident of a state with an income tax, her current marginal rate is a combined 40%. No good. We don't like that. So what if she rolled her IRA into a 401k? Well, voila, that just went away. We don't have to worry about that particular account being taxed at 40%. Instead, it's going to be withheld at 30% and taxed at some rate lower than that. Okay, so in summary, what have we spoken about here today? Covered expats are US citizens or long-term permanent residents who meet one of three tests when they expatriate, that is the income, asset, or tax compliance test. The exit tax involves classifying a covered expat's assets into 5 categories, which we have reviewed. And there are a variety of strategies that may be employed to help reduce the exit tax, as we just spoke about, including taking one's capital gains exemptions and stepping up one's basis, progressively gifting to a non-expatriating spouse, gifting to an irrevocable trust, or rolling, I shouldn't say ineligible deferred, it's actually specified tax accounts into, sorry, other way around, eligible deferred compensation. I'm sorry, I get it wrong again. See, it's in fact I have to edit this very point. It's rolling specified tax deferred accounts into eligible deferred compensation items. So that would be the example of the IRA into 401k. So just to share this with you, I have recently partnered with these 2 firms. There's Heinz Clark in Minnesota, CDG Corporate on the Gold Coast. Don't hold that against Dylan. But they are CPA firms. I've spent years and years locating the firms that I felt would be right for my clients and that had an understanding of the US, and conversely, if they were based in Australia like CDG, they had an understanding of the US side of things. And these are 2 firms that do. Any questions at this point in time? I would direct you, if you're interested in speaking with me in more detail, feel that we can assist in a long-term way. We don't do short-term project-only work, just to be clear. We partner with our clients. We want to be there for the long term to assist with transitions, help with retirement income plans, help with departure plans, and just be a trusted financial partner as life unfolds. If that's of interest to you, then I'd encourage you to come to Arete-WA, click on Get Started, go through that, and we'll find a time to chat. So I'm going to go to the Q&A first. Tracy writes, hi Tracy, thank you for joining us. I'm trying to find your YouTube channel to subscribe, but the one I found, the last post was a year ago. That would not be the right YouTube channel. Actually, you found it. Okay, well, that answers that. Easiest question all day. So next, we've got a couple things here. Melissa, glad to see you made it from the LA airport to Oz, which was the last session I saw you as you walked through your journey. Thank you very much. Ron says, bingo, to something way back when. Josh, hi Josh, thank you for joining. What is the way to remedy if someone did not certify but otherwise was not a covered expat? Josh, you'll have to clarify that question, I think, because I'm not really clear on what you're asking. What is the way to remedy if someone did not certify but otherwise was not a covered expat? I'm not picking up what you're putting down, I'm afraid. Okay, and Ronga writes, hi Ronga, any thoughts on a green card holder becoming a US citizen before moving to Australia to avoid being a covered expat? Well, that really doesn't make any sense. Let me see here. So any thoughts on a green card holder becoming a citizen before moving to Australia? You would not avoid being a covered expat. That's actually the surefire way of having more expense and more hassle is becoming a citizen. Other than the gifting limits, I don't know what benefit there would be to doing that. So it's all highly subjective. You know, the facts are so specific to everyone's circumstance. I would have to ask, Rhonga, why you would want to keep yourself in the US tax system if you're permanently relocating to Australia. If you're not permanently relocating to Australia, I get it. That makes all the sense in the world. But if you are, I'd have to wonder about that. Also, if you weren't already a long-term resident, that is 8 of the past 15 years, and you were seeking to become a citizen, then I would be really perplexed by why you would want to become a citizen. Kathleen, hi Kathleen. How can I determine the value of my US pension as it will be paid as a monthly amount? E.g. doesn't really list a total. Yep, I get you. Well, you're in luck, Kathleen, because way back here in the slides, as you know, will be made available to folks following the presentation. We do, in fact, talk about how that's calculated right here. So there's a present value computation method used for this is not an ineligible deferred comp account that you're talking about. This is a little different to that. This would be an employee pension plan. So that there's going to be a present value formula that you would use to calculate the lifetime benefit received from that plan. But that's a good question. And Sam, hi Sam, currently discussing with PwC about US Australian CPA services. Any particular reason you partner with the CPAs you listed as opposed to the larger firms? Really simple, yes, because PwC charge PwC fees, and they don't necessarily have any greater insight here as to those other CPA firms I've located that do. So there you have it. Some more reasonable fees, not paying Big Four fees to get the same or superior outcomes. Also, not that you're suggesting this, and I'm not suggesting you should, but if you were working with me, then it changes the conversation. I was saying to just some advisory friends of mine just a few weeks ago, the most amazing testimonial that I will ever share on this very point, Sam, and I promise you that this is true. I'm not going to reveal the firm, but you named one of the Big Four already. A spouse of a partner of the tax division of one of the Big Fours was inquiring about my services because of the nature of how these CPA firms tend to work, and that is they don't engage in planning. They're entirely retrospective. They say, great, you're now a covered expat. What are we going to do after the fact to possibly remedy that? There's only so much you can do after the fact. The real value of planning is prospectively planning and seeing what's coming down the line. So that would be a very different conversation between me and those CPA partners that I was alluding to earlier. Sarah, hi Sarah. I noticed on the slide mentioning the categories of people, citizens, 8 out of 15. The citizen category only mentions citizens from birth or something else I've now forgotten. Maybe that's where Ronga's question came from. Yeah, that's a fair point. No, that's an exemption. It's an extraordinarily narrow exemption. Here we are, either by birth or by parentage. So it doesn't exclude naturalized citizens, which I can understand that. So forgive me, that is ambiguous. I might have to get back to you on that one. No one has ever asked that before, and I've actually never even thought it. But it's one of those things where I must affirmatively confirm if you become a naturalized citizen, does that exclude you somehow from the, I don't imagine it would. It would go against all logic that would exclude you. What I think is Kellen, who did that, who put that there, I think he got confused between an exemption and it's if you get out before your 18th birthday and you didn't live in the US for a certain period of time, then you're able to get out. That's what that is to do with. It's not what what you're saying, Sarah. So Sarah, I welcome you to email me afterwards, and I'm going to follow up on that one because, like I said, no one's ever asked it, but I'm practically sure that that's just Kellen getting slightly confused between an exemption that applies for US citizens who leave the US before their 18th birthday and satisfy a bunch of other conditions. Harry, hi Harry. Does the value of a stock portfolio still get included? Yes, it does. Global net worth, yes, it's included. Everything under, that's why I said couch cushions. Absolutely everything, look everywhere because it will be included. You're welcome. Let's see how the Q&A panel is doing. I didn't have that open. I was looking at the chat panel. What do we have here? Trying to open this up. So Clay, for visa holders, E3, looking at switching to apply for a green card, does it make more sense to hold out to switching as long as possible if you plan on returning to the US? Clay, this is not personal advice, right? We saw that on the very second slide of tonight's presentation. This is not personal advice. However, if that was me and I was an E3 holder and I looked at my financial trajectory and I saw it was going up and up and up, and if I converted to a green card and I was likely going to stay more than 7 years and therefore be a long-term permanent resident who was relinquishing their green card, who would meet one of those 3 tests and be subject to an exit tax and therefore subject the next generation to an inheritance tax, then I would stay on an E3 because the clock never starts. Matthew Anderson, hi Matt. Maybe I missed this, but are all assets included in the repatriation tax calculation just US? Global, my friend, global. Okay, Phil, hi Phil, good to see you. If you have a joint revocable trust that, say, for example, you own your house with, like your spouse, for instance, are you liable for your share or the net asset value? Great question, Phil. The whole thing is yours. Joint is counted twice. So the whole thing gets counted to you, and then the whole thing gets counted to your spouse as well. But for determining the $2 million net asset test and the amount of tax you have to pay on any gain. Yet again, where planning comes into effect, you might choose to, and I'm working with a client right now on this very point, where they have joint assets that we're unbundling and gifting to the lower income, the lower net worth spouse for this very reason, to help out with their exit tax that's likely coming down the line if they don't do anything. Kate Cropper, hi Kate. Can I reduce my asset values via mortgages and guarantees over these assets in my name? Wow, okay. Well, let's think about that, Kate. I would say no is the short answer to that. Why? Because if you had a $2 million house, then you went and took out a mortgage on your own house, which is a pretty unusual thing to do. Where did the money go from that mortgage that you took out? It's probably sitting in a bank account. So while there's no gain necessarily on that money, you're paying interest on it, it's still part of your global balance sheet. It's not shifting it. It's not reducing your net worth. However, if you already had a mortgage on the house, and therefore your net equity was less than the fair market value of the house, then only the fair market value of the house is being included. So I want to be careful about how I answer your question, because there's 2 ways to go at that. One would be sort of the reverse mortgage, which wouldn't help you out at all. One would be if you did in fact have a mortgage, would that be helping you out? Well, it's hard to say. Now you're paying interest. Linda, we need help with capital gains tax incurred in the US from the sale of a property in Australia. We do not meet the criteria of covered expats and are now Aussies with green cards living back in Australia. Would you recommend Steve Hines to help with this? Let me read this a second time. Capital gains incurred in the US from the sale of a property in Australia. Okay, I can see how that would happen. Yep, because you're US tax residents, because you are green card holders, no matter where you are, you will always be US tax residents. We do not meet the criteria of covered expats. That's fine. And are now Aussies with green cards living back in Australia. Great. Would you recommend Steve Hines? Yeah, I would. Yep, Steve would be a great help with that sort of thing. Yes. Kathleen. Okay. Hi, Kathleen. I can probably gift myself below the $2 million limit, but my kids will inherit the whole enchilada and be over $2 million each for sure. Well, here's the thing, Kathleen. That's a fair point. See where you're going. Yeah, it really depends. They're probably too young to, I mean, almost definitely too young to make any predictions about their long-term residency intentions. But what I really don't like about this HART Act is how the limit, the $2 million amount, is not indexed for inflation, but the exemption is. So it means effectively, as assets increase over time and everyone's net worth increases over time, hopefully, fingers crossed, that bar is lowering. So it's capturing more and more people, as you're alluding to here. Really, all one could possibly say here would be to be mindful of their residency intentions and understand that the US has a very complicated citizenship-based tax system, and there are profound implications to being a US tax resident. Seems to be everything. The chat panel and the Q&A panel have slowed down a bit. I'm going to assume everyone's hypnotized, bedazzled, mesmerized, so enthralled with what I've shared here that they're gobsmacked, and we'll keep their questions coming. But thank you, Kathleen. I welcome you to attend next month's presentation. Typically, we will notify you about a week out before that. Thanks, Antonio. Look forward to speaking with you in a few weeks. We'll notify you about that topic. I should mention, just in case any clients are on the call, which some are, that this is nice. I think it's great just for your own homework to attend, but I am already doing this and incorporating this into the advice that's given, so it's intended to save you from the heavy lifting. Thank you, Cameron. Headaches, well, now that it's 9:30 on the East Coast, then maybe you could have a cocktail and relieve that headache. Thank you very much, everyone. I look forward to seeing you next month. It's been a pleasure.